What's up everybody, Gen X Dividend Investor here. In this video I share valuable lessons about dividend investing that I wish I had known earlier in life. I'm also going to respond to a dividend hater's TikTok, and I think you'll enjoy sticking around for that. So if you're new to my channel, then I'll summarize things by saying that I retired over 4 years ago in my 40s once my dividend income was able to pay all my family's expenses and a bit more. Now I'm in my 50s and have been investing in the stock market for over 30 years, so I've gotten to experience lots of crazy market conditions, including crashes, the lost decade, and of course, nice bull markets. I absolutely love owning blue chip dividend paying companies, and that passion about ownership and dividends is the first thing that I'll tell my younger self about, i.e. that as time goes on, my quality dividends will become one of my greatest joys in life. I mean outside of family and friends and such. Now when I first started investing, I did it because it was suggested to me and because my friends at work did it, not because I was enamored with it. I mean, it made sense to save for your retirement, and so seeing some of my paycheck disappearing into stocks seemed like a decent gamble to me, though I had some fears about doing it. Back then I honestly knew almost nothing about investing, and so putting my money into stocks kind of felt like gambling. I was worried that I'd invest and my stocks would go down, and I didn't really internalize that the market had historically trended up. Most of my knowledge about stocks came from my 10th grade economics class where we did paper trading for a week. We'd look at tickers in our local newspaper, and for an assignment we all got some virtual money to invest. The kids in the class basically just randomly picked stocks, and the teacher didn't talk about buy and hold investing or putting your money into quality companies or anything like that. Or maybe he did and I didn't listen because I didn't like the class to begin with. I ended up gambling on some penny stocks for the paper trading assignment, not even knowing what the companies did that were behind the ticker I bought, and I pretty much put my money in anything that seemed super volatile in hopes that I could buy low and sell high. I got lucky and made tons of virtual cash by doing that, but later my teacher told me that one problem I wasn't aware of was that each buy and sell had a fee, so my huge buys of penny stocks wouldn't quite play out in the real world like they did in the class. Bottom line, I was clueless to how stocks and investing actually worked. Heck, ETFs didn't even exist in the US back then, though mutual funds tracking indexes did exist. The first American ETF that came out was State Street SPY in 1993, and it remains the largest fund in the US with almost $600 billion in assets. SPY is kind of like VU, though it has some differences. One thing most people don't know is that each share of SPY contains a tenth of the SP 500 index and trades at roughly 1/10 of the dollar value of the SP 500. So like at the time I'm filming this, the SP 500 is at $59.91. If we check SPY, we see that it's about 1/10 of that and it trades at $5.97. And for reference, Vanguard didn't start offering ETFs until 2001, which is when VTI came out, and VU didn't come out until 2010. That being said, Vanguard launched their first index mutual fund, the Vanguard 500, in 1976. Anyway, there weren't a lot of available resources to learn about stocks when I started investing, at least that I was aware of, and my dad wasn't a fan of stocks, so to me it felt safer to just save cash in the bank, but I invested because I listened to my coworkers. And I never thought the day would come that I would love investing, and that I'd look forward to getting my cash working for me rather than me just working for my money. I love being an owner of companies that have products I use, rather than just being a customer. It didn't really sink in that buying a ticker was basically like buying a small piece of a company. Like when I originally bought McDonald's stock, it felt just like I owned something on paper. But years later my investments felt tangible. When I'd go to McDonald's and had to stand in a line of people, I'd actually be happy that my business was doing well. I got a cool sense and pride of ownership from my investments, and that acted as further motivation to invest. And the fact is that wealthy people tend to own assets which appreciate over time, and their goal is to acquire more good assets. Folks that don't have that asset mindset tend to see cash as a way to pay bills and then maybe save some in the bank if they can. But the more you invest, the more you build up a passion for it, and it's common for investors to wish they'd started sooner in life and had invested more. Of course, the key reason you invest is because of the financial benefits they can enable. I'm most passionate about my dividend stocks because they allowed me to retire early, and now my dividends pay our mortgage, our healthcare, our groceries, our vacations, and all that jazz. My dividends let me escape the rat race, and it was all possible due to the investing I started decades earlier. And that ties into the next thing I wish I understood more when I was younger, which is that with each quality dividend stock you buy, your passive cash flow increases. That concept of being able to build a new stream of passive income, kind of like creating your own pension plan, is something that would have really motivated me more if I'd understood it better earlier in life. I mean, being able to get a new source of cash coming in that can grow on its own, potentially for your life and beyond, is pretty astounding. Plus, quality passive income provides a path towards financial freedom as it potentially reduces your reliance on needing as much job income, and ultimately is a way you can retire earlier and or better. The more sustainable passive income you have, the more likely you'll get to live the life you want on the terms you want. I can't stress enough how much I appreciate my dividends freeing me from needing to work at a real job, giving me more time to be with my family, as well as to enjoy hobbies like social media or working out or watching Netflix or whatever. It's pretty amazing knowing that my passive income is flowing into my accounts while I'm geeking out playing video games with my friends. And the more your dividend income grows, the less stress you have in life. Like not needing to work and having more free time does wonders for your psyche, which also means positive health implications. Beyond all that, knowing that good dividend stocks usually raise their dividend more than inflation would be another key learning I'd want my younger self to know about. Great companies raise their dividend every year, and they tend to raise it by more than inflation, on average, over the long run, which means that your buying power is continually increasing. Compare that to people who just have cash in the bank, which generates interest, but usually at a rate lower than inflation. Another key learning I wish I'd internalized when I was younger is that your dividend cash flow can be passed on to your kids, allowing for true generational wealth creation and hopefully an easier and better life for them. Now sure, some financial struggle in life is good for you, and eventually for your kids, and working hard is also good, but I'm not a fan of jobs that are toxic, which unfortunately many of us experience, and it's not always easy to get another job. I'd love for my kids to have careers that they enjoy, or at least don't hate, and so my dividend cash can hopefully make the lives of my descendants better than mine has been. I really find it inspiring to think about my dividends continuing to generate income and providing value long after I'm gone. It's like part of me lives on, helping those that come after me. I've never inherited anything, and I'm not sure I'll ever actually inherit anything from my divorced parents due to their own struggles, so me being able to eventually leave my kids something really brings me joy. Plus, it's cool knowing that my dividends will pay out even if whoever inherits them knows nothing about the stock market. I mean, it's hard to find assets which generate income so passively and without stress, especially assets which often keep growing. That all being said, I still advocate for people to keep the pulse on their investments. And related to that, another huge benefit that I'd teach my younger self about is that dividends also can cover your behind if you physically can't work. Like I talked about some of my memory and health issues in the video I shared called What I Learned Living on Dividends for 4 Years, so it's been especially valuable for me to have passive dividend income as holding a job became more challenging for me. Moving on, another core thing I wish I'd known when I was younger was that the hardest time for most people to invest is when the markets crash or when they go sideways for an extended period of time, and those times are when dividends will probably be your only source of returns. And not only that, but the best time to invest is often when everyone else has given up, because that's usually a sign of being near a bottom, and the best time to buy is when things are on sale. But crappy stock markets were the main thing that concerned me about investing, at least until I understood more about dividends. Before that time, I wondered what would happen if we had a really bad market and someone was retired and having to sell their depressed stocks to get income. That sort of scenario understandably turns some people off to investing. Or seeing the market go sideways for many years could also deplete people's retirement accounts. Like I experienced the last decade firsthand, and it really showed me about the power of dividends. I invested through the 12-year period where the S&P 500 was under its previous high. Specifically in September of 2000, right before the dot-com crash hit, the S&P 500 was at 1520. And then it went down and up and effectively sideways for the next 12 years, and in February of 2013 it was at 1513, so still under where it was 12 years earlier. Imagine the scenario of someone who had finally amassed a portfolio worth $1 million by the year 2000, and so they decide to retire. Let's pretend they needed 40 grand a year to pay their expenses, and let's assume they didn't have any other sources of income. Watch how fast things could go from looking awesome to quite ugly. Here's a simple spreadsheet I put together to model out a scenario where the market is basically going sideways for a bit over a decade, and where inflation is averaging about 2.3% per year, on average, which is what it did. So our retiree starts with $1 million portfolio in the year 2000, and that year there was a 3.4% inflation rate, and he had 40 grand in expenses, which he paid off by selling off part of his portfolio because he's not in dividend stocks, so he ended at a portfolio worth 960 grand. Then in 2001, his expenses go up to 41K due to inflation, then they're 42K in 2002, then 43K in 2003, all the way up to 53K in 2012. He isn't living a better lifestyle each year, it's just that everything continually costs more over time. And because the stock market isn't going anywhere, his portfolio value continually erodes. So he's down to 918K in 2001, then 876K in 2002, all the way down to 395K in 2012. Imagine how scary that might be if that's what happened to you. I mean, in the year 2000, you're riding high with $1 million of buying power in your portfolio, stoked that you finally retired. But as the years go on, you see the market trend basically sideways, and 10 years into retirement, you are down to a portfolio worth 395K. Thus, you've lost 60% of your buying power, and even scarier, you'll be broke in 6 or 7 years if things continue, or even sooner if inflation is worse, or whatever. That situation happened to some people out there, and while I'm cherry-picking dates of starting retirement when the markets are high, the reality is that sort of thing happens in real life. Like many people retire when they feel that they're in a good financial spot, which is when the markets have been good, and most try to avoid retiring when their portfolios have taken it in the shorts. Well, at least non-dividend retirees do that. Us dividend investors usually keep getting our cash flow regardless of what's happening in the markets. My point in sharing that is to highlight what can happen in the market and to stress how important the mental game is when it comes to investing. Your takeaway shouldn't be that investing is too scary, but instead that you gotta invest for the long run, and a strategy of having to sell assets, at least to me, isn't that compelling. That's a key reason why I embrace the strategy of investing in quality dividend stocks, and that's something I'd want my younger self to know about more. I'm confident that even in crappy markets, people will keep using the products and services of the companies I own, which tends to mean I'll get paid a share of their profits in the form of cash dividends. And even if my stocks go sideways for over 10 years, the companies behind my stocks will probably still be making money and thus transfer some of their profits to their shareholding owners, who then get to enjoy the passive income. Passive income also enables another core concept I wish I'd known about sooner, which is the compounding aspect of a dividend snowball. You can reinvest your dividends as they come in, using them to buy even more shares, which is like getting interest on interest at the bank. Reinvested dividends compound over time, creating the potential for exponential growth and wealth, and it increases the amount of the company you own. And non-dividend investors who say they can just sell shares to manufacture a dividend might not realize that they're also decreasing their ownership percentage when they do that. I'd rather keep owning more of a company, not less, at least as long as I liked it. Anyway, if I had shown my younger self this graph of my estimated dividend cash flow growth over the next 10 years, it probably would have motivated me to invest even more. So over the next 12 months, I'm anticipated to make about $131 grand if none of my dividends are raised or cut, and I normally get way more raises than cuts. This graph highlights a core concept I wish I'd understood more when I was younger, which is how powerful dividend growth is. The blue bars are the top line of numbers, aka my no reinvestment line, which estimates my year-over-year dividend income, assuming I'm spending all my dividends, but I continue to get dividend increases like I have been. After year one, I'm estimated to make $138 grand a year. Then the year after that, I'll be making $145 grand, followed by $153 grand. 10 years out, and this estimates I'd be making about $218 grand a year in dividend income. I wouldn't need to do anything for that increase in cash flow other than just keep holding my companies. And even crazier is if I was reinvesting all my dividends over those years, which means my income would grow even faster, both from dividend hikes and from buying more shares with the dividends. Reinvesting dividends instead of spending them is reflected in the bottom row of numbers and are the red bars, and in that reinvested dividend case, I'd be making $309 grand a year a decade from now, rather than $218 grand a year. And that is the power of compounding and of a dividend snowball, and I think if my younger self knew all that, then I would have probably invested even more. This graph also speaks to why time in the market is so important, and why quality stocks are so important, which is another core concept I'd drill into my younger self. That reminds me, I read that the annual bankruptcy rate for small cap companies in the US often ranges from 1 to 2% in stable economic periods and spikes higher to 3 to 5% during bad times. And even S&P 500 companies can go under. Like, think of well-known companies that went bankrupt, including Lehman Brothers, Enron, and General Motors, though GM restructured and returned to public markets. The reality is that if you want to invest in single stock companies, then you really want to do your due diligence to find quality companies that can persist. Of course, everything eventually goes under, so make sure you focus on solid companies to give yourself the best shot. You want to own quality companies as they have the best chance to appreciate and pay out more in dividends, if they're a dividend payer. As a younger person getting into dividend stocks, it might be tempting to chase higher yield and forego growth, but a younger person should probably be focused on what will yield them the best total returns. And tied to all that is another key learning I'd pass on, which is that ETFs are generally a safer and smarter way for most people to invest, and many of them also pay dividends, and usually the smaller the yield, the more the growth potential it will have. Like SPY has a 1 to 1.5% dividend yield, and its total returns will probably beat out most people's individual portfolios, as well as many other ETFs. Thus, I'd recommend most young people put all or the vast majority of their investable assets into a broad market ETF, and then if they want to try their hand with some individual stocks, then do that with a minority of their investments. Then after a few decades go by and you get closer to retirement, you can always switch gears and push more of your portfolio into individual stocks with higher yields. Or do whatever you want, but make sure to invest and live within a budget. Yes, you can still be successful sticking only with single stocks, but generally speaking, that's a harder road. So whatever you do, just think carefully. And along those lines of thinking carefully, another key learning about divvies that I'd want my younger self to think more carefully about are taxes. You want to understand what MLPs are and how return of capital works with them, and why they tend to be best in taxable accounts, and how REITs are usually taxed as ordinary income, and can have some capital gains or return of capital tossed in there as well, which is why holding REITs in a tax advantage account often makes more sense. You want to know about how international stocks are taxed, and how you probably want to have qualified dividends in your taxable. And that leads to another critical thing I'd drill into my younger self, which is to use Roths and HSAs as it makes sense for your particular situation. Neither of those existed when I started investing, so I focused on a traditional IRA and then made the mistake of not pushing into Roths or HSAs when I finally found out about them. Another key thing I'd tell my younger self is to not blindly follow the advice of those around you. Listen to what they say, sure, but don't knee-jerk react without thinking and analyzing. I'd also say be careful about drawing broad conclusions based on limited data. For example, take a look at this short video.
Dividend investors are embarrassing. These are the supposed dividend kings in 2024. If you look at the top kings, you can see that they've made no money compared to a passive low-fee US index. Dividends are not free money. The value of the company goes down by the dividend paid. Anyone who invested in the top kings made no money outside of the dividend. People who invest for dividends are literally sacrificing $100 in total return just so they can see $3 deposited in their account. Makes no sense.
Now, I normally don't respond to others' investing videos out there, but someone shared this on my Discord and I thought it would be helpful for this video. I have no idea who the guy is in that video, but I'm guessing I'd probably agree with lots of what he says in other videos. Anyway, he started off by saying that dividend investors are embarrassing, and he's entitled to his opinion, though I'm proud to have retired due to my dividends paying all my family's bills at an age where only 2% of Americans are able to do the same. He continues on saying that if you look at the top kings, and his definition of top kings are apparently the ones with the highest yield, then they've made no money as compared to the SP 500. He shows a picture of stock price returns over the last 5 years for the SP 500 as well as for a few of the highest yielding dividend kings, starting with Altria. Of course, only showing stock price returns will miss out on a core aspect of returns for a dividend stock, i.e. its dividend, and I'll show you some data on that in a moment. Then he said something I agree with, which is that dividends are not free money, and I've done an entire video explaining the nuance behind that. He continues on saying that the value of the company goes down by the dividend paid. Now, it's true that the stock price of a company goes down on its ex-date by the amount of the dividend, but he's kind of making a mistake in that the value of a company and its stock price are not necessarily the same. Yes, some people do look to market cap as a representation of the value of a company, and it's calculated by stock price times the number of outstanding shares, but that more reflects the market's perception of value, not the company's actual value. Graham's famous quote helps us clarify things a bit. Graham said, "In the short run, the market is a voting machine, but in the long run, it's a weighing machine." So in the short run, the price of a stock tends to reflect its popularity more than its value, but over time, the market focuses less on popularity and more on the actual fundamentals of a company, such as earnings, cash flow, and business growth, which is then more accurately reflected in stock price. Now, it's true that when dividends are paid out, a company's financials are reduced because they're basically transferring some of their cash to us shareholders in the form of a dividend, but the real intrinsic value of a company usually isn't its stock price at any moment in time. Our TikToker continues on, saying that anyone who invested in the top kings he mentioned didn't make any money outside of the dividend. But that's also incorrect, because even Altria in his screenshot shows a 16% return, but yes, it's mostly about its dividend these days, so not including dividends in the graph is either an oversight or a purposeful attempt to understate its total returns. Let's actually dive into Altria for a moment. When we pick the 5-year time frame he used, then indeed Altria is underperforming, even from a total returns perspective. Its total return is at 77% versus the SP 500, which is almost at 110%. But when you look at other time frames, you can find Altria overperforming, which he didn't mention. For example, if you look at over the last 30 years, then Altria has returned over 5,000% compared to about 2,000% for the SP 500, so over double what the market has done. And it's not just long time frames, because if we look over 1 year, we see that Altria has returned about 49% as compared to 38% for the SP 500. Which reminds me, what would you guess is the best performing stock of all time? Hit pause on the video and leave me a comment telling me what you think it is, and don't Google it and don't read other people's responses. Go ahead, hit pause and leave your answer. Now, some of you might guess Berkshire Hathaway, and that's a good guess. Others might say Apple or Amazon, or maybe a stock that's been around forever like Coke. But the funny thing is that while my good TikTok friend was ragging on people who invested in Altria, what he failed to mention, or perhaps didn't realize, is that Altria has been the best performing stock of the last 100 years. In fact, if you'd invested $1 into Altria, formerly known as Philip Morris, back in 1925, then your dollar would have turned into $2.65 million today, a 265 million% return, which is 16.3% annualized for 100 years. Now, do I think Altria is going to perform like that going forward? No, but do I think Altria can make sense as part of a portfolio for retirees like myself? Yes, I do. So there are various takeaways from all that, including that it's kind of silly to talk about how dividend investors are embarrassing for how they invest, and that the analysis he did could probably be improved. Like just looking over one time frame at a subset of kings and then drawing broad conclusions might not make sense. I mean, I could always pick 4 other dividend kings like Parker Hannifin, Nucor, AbbVie, which I own, and Grainger, and find out that they doubled the performance of the SP 500 over the last 5 years. So like a $10K investment in the 4 Kings I mentioned would have grown to over $33,000 over the last 5 years, a 28% annualized return, as compared to the SP 500, which would have not quite doubled your money to about 19 grand, a 14% annualized return. Then I could say something silly like, so clearly people who don't invest in the best Dividend Kings are literally sacrificing 50% of the total returns possible. And it's not just those Dividend Kings that outperformed over the last 5 years, because Lowe's did, and Walmart did, and SPGI did as well. But since this video is about Dividend Kings, then why don't we look at the performance of all Dividend Kings rather than just a few of them? So I googled if anyone had done that analysis and found this article on Seeking Alpha, published in 2018, of someone who had done just that. They looked at the previous 10 years of returns for all the Dividend Kings and compared that to the SP 500, and they found that in total the Dividend Kings returned 110%, beating the SP 500 which returned 104%. Now based on that, would I conclude that investing in the Dividend Kings is smarter than the SP 500? No, I actually wouldn't. I'll just summarize my perspective by saying that I'd imagine the Kings will outperform during bad periods of time, and we can see how they lost less in 2008 when the market fell 37%, whereas the Kings only fell 18%. So if we end up having a big market crash in the near future, then yeah, I bet the Kings on average will outperform. Good dividend stocks tend to lose less in down markets, and they still tend to go up in good markets, and even when markets aren't doing anything, you'll still get your dividends, which is very motivating and helps you stay the course. Sometimes you'll probably outperform the market, and most of the time you probably won't. I recently showed you in Fidelity how my portfolio has beaten the market for the last few years in that 4 years video I just released, though I also caveated that by saying that I doubt I can continue beating it unless we go into a down or a sideways market. I hold some sin stocks and energy stocks and some income ETFs, none of which I'd imagine will outperform over the long run. And whatever you invest in, try to avoid constantly buying and selling new tickers, and if you're going to invest in single stocks, then learn how to calculate when a stock is cheap. My favorite tool to do that is Fast Graphs, and I feel it gives single stock investors a huge advantage. I'd also recommend that serious investors seek out other investors to mingle with. My free Dividend Discord is a great option, and engaging with others in the comments section of Seeking Alpha articles is also helpful. For example, a couple days ago someone on my Discord asked why AbbVie was down 15% pre-market, and someone else responded that their schizophrenia drug results were disappointing. The first guy said thanks, and that he hadn't seen any reasons why they were down. Now I also knew why AbbVie was tanking so hard, because Seeking Alpha had mailed me a link to an article explaining what was happening in real time. I really value both Fast Graphs and Seeking Alpha, which is why I'm affiliates for both of them, and are valuable enough that I'd tell my friends and family members to consider paying for them. Seeking Alpha actually has a Black Friday sale from November 18th to December 3rd, 2024, and it looks like they're offering a big discount on Seeking Alpha Premium. They also are offering a special for a subscription called Alpha Picks, which is something I never tried, but they said that their Alpha Picks portfolio has beaten the SP 500 by over 50% since they started it in July of 2022. Anyway, another learning I'd impart on my younger self is that investing in US stocks has historically been the best and easiest way to grow one's wealth if you stick with it for long enough, and that the US economy is often the envy of the world. In fact, 80% of the World Bank global growth forecast is anchored in America's astounding GDP growth, and last year's feared hard landing never happened, which is a testament to how powerful SP 500 companies are, 80% of which pay dividends. Beyond that, I'd share 9 other quick reminders to my younger self, which are: Number 1, focus on dividend growth, not just high yield, as chasing high yields can lead to risky investments. Companies with strong dividend growth often have healthier fundamentals and can provide more reliable long-term income and better total returns. Number 2, beware of dividend cuts. Even the safest looking dividends can be reduced or eliminated. Always assess important financials like the payout ratio, company debt, revenue and income and cash flow trends, and be aware of how your company's industry is evolving. Number 3, remember that sector diversification is important and that certain sectors, like utilities and consumer staples, are known for reliable dividends, but overconcentration can hurt if a sector underperforms. Number 4, have investing fortitude such that when you buy something, then intend to own it for many years. Number 5, beware of emotional investing, as dividend investing requires patience and discipline. Don't sell in panic during market downturns, and don't overbuy based on euphoria. Number 6, stay on top of your investments, because the truth is that companies evolve, and what was a great dividend payer a decade ago may no longer make as much sense. The reality is that any company can go under. Number 7, think long-term, but stay flexible. Life circumstances change, and so will your goals. Keep your portfolio aligned with your needs, and don't be afraid to adapt strategies over time. But also be careful of changing too much. I mean, many people try an investing approach for a relatively short amount of time and don't end up benefiting from its long-term potential. Number 8, don't ignore total returns, because while dividends are crucial, you don't want to overlook capital appreciation. A balance between yield and growth stocks is essential for long-term success. And finally, and probably most importantly, number 9, hit that thumbs up button, subscribe if you haven't yet, and click that bell notification, as all that really helps. And now I'd like to shout out a few of my recent Patreon Aristocrat signups. So thank yous go out to Wannabe Saiyan, Mal the Space Pirate, and a grateful man who signed up for an entire year. And please leave me a comment telling me what things you wish you could tell your younger self about. Please check out my Fast Graphs affiliate link along with my coupon code in the description of this video, as using both should allow new users to get 25% off the first payment, even if they sign up for a full year. I'll also suggest that you try out my Seeking Alpha affiliate link, as new users often get good discounts for signing up. Plus, take a look at my Patreon seats, see if there's any you want to sign up for, but if those are sold out, like they often are, then please consider joining as a channel member, as it has a slew of perks I think you'd enjoy. Finally, don't forget to join my free Dividend Discord chat server, which has over 11,000 Dividend investors on it from 83 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.